Nice to meet all of you over the phone. Yeah, so John's met John about a year ago, helped him refinance his deal on Lombard in Berwyn. It was a nice transaction. I think we did, what was it, a 15-year term with several years of interest only at a great rate on the non-recourse side. So I work for a company called WalkerDunlop. So we're based in Bethesda, Maryland. That have, call it 40 offices across the country with an office here in Chicago. So we're a commercial real estate financing firm. 80% of what we finance every year is in the multifamily space. The other 20% is all the other food groups, retail, office, self-storage, et cetera. But we're a dominant multifamily lender. We are the number one Fannie Mae DUS lender in the country. We have been 5 out of the last 8 years, and usually top 3 with Freddie Mac and HUD as well. Last year we did over $20 billion in multifamily finance across the country. So we're one of the dominating multifamily lenders. We do focus solely on multi, so it has to be 5 units or more. Deal size, really we're kind of limited to $1 million and up. But there's 2 different programs, and I think the program that would be better fit for this investor group would be the small balance loan program, which is what John and his partner took advantage of a few months ago. So that space, there's the Fannie Mae and Freddie Mac small balance loan programs. They kind of, like I said, the loan ranges sizes from 1 to 6 million. On the Fannie side, you can do, term anywhere from 5 years to 30 years if you want to. There's, interest only is available. Significant interest only in most cases is available. I just signed up a deal today where we're doing a 10-year deal with 5 years of interest only at a sub 3% rate. So the agencies have lofty goals to get money out the door. Even with the COVID pandemic going on, there's a ton of business that they want to get done, and they're pricing aggressively to meet their goals. Just standard 10-year money today, pricing on that is in the low 3s on a non-recourse basis with some interest only, and then add their 30-year amortization thereafter. So they, with regards to just overall terms, not just loan term, but interest only availability and non-recourse, the pricing is probably better than your local bank by a pretty large margin these days, especially if there's an affordability component, which John's property had. His property met affordability. 100% of the units were at an affordable level per the agency guidelines. So that just results in better pricing and better terms, because their goal is to provide safe workforce housing for people earning less than the area median income. So that kind of sums it up. We have, like I said, I do a large range of deals, anywhere from 1 million, and I got a deal right now we're on that's north of 40 million. So it's a wide spectrum, but as John can attest, it's a little bit more work than a bank loan, probably, because it's a non-recourse loan. They're not making you sign over your balance sheet as a guarantee. So there's a little bit more paperwork, but we make it as easy as possible on that front. And I think John would agree that it was all things considered, somewhat of a smooth experience, and we got the deal done as outlined in the application. So
Luke, you were awesome. The attorney we hired was not, but you were awesome.
We had some hurdles on that one. That's a great property. You did a great job repositioning that thing. That's going to be a great long-term investment for you. And now you got great debt to just not have to worry about it for the foreseeable future. So that's the whole goal. We can do shorter term debt, 5 years to kind of compete with banks. But I'd say almost all my clients do 10, 12, 15, sometimes 20-year loans, just because they cash flow. They add value, and they just continue to kind of, rinse and repeat, if you will. So that's
Can I ask you a couple of questions about,
Sure.
So I know in this group in here, there's probably a lot of people who have properties that are worth $300,000, $400,000, $500,000. Probably
Yep.
to a lot of people, $1 million loan sounds completely unattainable. I know that I'd asked you the one time about packaging buildings together. How does that
Yep.
work? Like, so a lot of people in here may have buildings that, you know, are worth more than
Yeah. So
$1 but they
right.
could get there.
Yeah. So there's a waiver for everything, right? So programmatically, they want each property to have 5 units, and they don't want properties to be more than call it 2 or 3 miles apart. I have in the past gotten approval for deals that aren't 5 units, but are a much closer proximity, either in contiguous parcels or kind of in the same neighborhood. Where I just recently got a quote where there was 3 4 unit deals all on the same. I think it was separated by 2 blocks, and together we were able to put together a deal for them on a non-recourse basis at a rate that was way better than what his bank could offer. They made an exception there because it was affordable housing in a market they liked, and the properties were close. So if you have several properties kind of within a close proximity, um, even if it doesn't hit, even if it doesn't fit the box perfectly, you can always go in for an exception or a waiver request, and see what happens.
And then the other thing is, I know you spit a lot of big, big terms that maybe some of the people in here may feel like are intimidating. What is a non-recourse loan for those of us who've never heard that term?
Yeah. So that's all I do is non-recourse lending, right? So when you go to your bank, let's say you're doing a duplex, that you're acquiring a duplex, or you're buying a 3 unit and living in a unit, you go to your bank, you do what's called a resi loan, a residential loan. You're going in, they're underwriting you as the guarantor. You're signing personal recourse, meaning you're fully liable to repay that debt, regardless of what happens. That's your standard single family and up to 4 unit loan that Chase, Wintrust, Wells, whoever can get you. Where I'm at is it's more on the investor non-recourse side, meaning you can borrow money. Usually, obviously, you create a borrower as a single purpose entity to buy a property, usually an LLC. And then usually there's a flow of control through an org chart that kind of goes down to the controlling interests or key principals, in which case the deal I did for John, or John and his partner. They were both the key principals for the loan. Now they are signing the loan docs, promising a repayment, but they're not pledging their personal balance sheets. That's the non-recourse component of it. So long as they don't commit fraud, misrepresent in any way, in the event they had to give the keys back, we couldn't go after their personal assets. All the liability is held at the property level. So that's the big difference. So as long as you're not a bad boy and trigger one of the carve outs in the loan docs, you're not risking any other assets that you own.
And then I know the other word that you use that probably some people that are looking at, like, say, a house hack for the first time, they're not sure what it means, is the loan term. Could you
Yep.
explain like that little nuance with like a 10-year money versus, the way it is in residential financing?
Yeah, so a lot of times your standard single family or duplex or whatever, you do a 30-year fixed loan, right? So it's 30 years fixed at the same rate. Sometimes like you can do a 10-year arm, which is actually what I just did when I recently relocated to Western Springs, just because the rates were much better. So when I say it's a 10-year deal, 30-year amortization, it means the loan is a 10-year fixed rate. So let's say you lock your rate at 3%. You're fixed for 10 years, but it's over a 30-year amortization. So it's assuming a 30-year schedule, but the loan does mature in year 10. So you'd have to refinance at that time. Similar if you do a 12 or 15-year deal. In our space, once you hit that term, you got to refi. Of course, you'll have a balloon balance because you're paying it assuming a 30-year schedule.
Nice. But I mean, like the local banks typically don't do 10 or 15-year terms, I think is kind of what you're alluding to. If you go buy like a 5 or 6 unit, for instance,
Yeah. So
you get a
yeah. So
5-year term.
You're right. So like on the commercial side. So if you're doing a non-resi loan, so if it's a 5-unit deal or bigger, most of the banks, and I'm an investor too. So I got 3 flat in Logan Square, a couple deals in Colorado, and I had some stuff at Humboldt Park that were all 3 flats, 4 units, whatever. The terms I got on those deals were 5-year term, 25-year amortization, full recourse at whatever 4+% rate. So it's not the greatest terms. That's the standard kind of bank deal that you get when you are outside the residential space. If you're 2 to 4 units or single family, there's some good terms, but once you get 5+ units, it's really important for you. And so long as like I said, a decent deal size. I mean, where I work, Walker and Dunlop, we really say kind of 1.5 million and up. I mean, there are other shops that are smaller than us that will do maybe an $800,000 deal, if it's 5 units or whatever. But yeah, if you're in that space, it's to your benefit to consider the non-recourse Fannie Freddie route over your local bank, because you're not signing personally, and you're going to get better terms and not have to sign personally. So it's really, the closing costs are a little higher, but as John will, agree, it's worth it long term to take advantage of interest only and have a longer fixed rate term on a non-recourse basis.
Yeah, I mean, obviously that I was very, very happy. I think a lot of people on here follow Bigger Pockets and follow the BRRRR strategy, where you buy, renovate, refinance, rinse, repeat,
Yep.
something like that. There's more R's in there that they like to put, but I mean, I think what I found with the Fannie Mae loan is that you could actually do the cash out refinance and get all or most of your cash back. A few little issues with
and you
COVID.
have right. And at closing, we do need a cash out, and then you also have an opportunity to do a supplemental, which is essentially a second bite of the apple, or to kind of recoup, additional value you create down the line to get more money in your pocket. So that could be. We did a 15-year deal, right, John?
Yeah, ours was 30-year amortization, 15-year term, and it was
with
10 years.
10 years interest only.
Yeah, which was awesome.
Right. So you essentially would have 8 years or so to come back and do a supplemental and see how it sizes up. Now you're gonna, the interest only component, you're not going to pay anything down. But if you have nice rent growth and the deal sizes up, that's an option to get more money into your pocket and to still maintain that nice low, first mortgage.
Yeah, no, I mean, it's a really amazing loan compared to like a local bank, because I refinanced a 6 unit after we did that, and I almost cried at how much worse the terms were. It was okay, but
and you're signing over your personal balance, and you're signing
right.
over your personal balance sheet. So that's yep,
exactly. So I know this is kind of an interesting topic where a lot of people may feel out of their element. Does anybody have questions for Luke? And I mean, truly, this guy is like a master of this space. But
and listen, and real quick too. I mean, I'm happy even on the smaller deals, if they're 2 to 4 unit deals. I got a lot of contacts too. I'm not.
So
I'm happy to share my contacts with you on the bank side to help you out, so you have more options on the lending side if it doesn't fit our bucket.
Will we have your contact information? Will John send it over to us? Or
John has it, or I can just send it to him.
Yeah,
and we can circulate it.
Of course, I'll even put it in the chat while we're talking. JR, go ahead. You had a question for me.
Yeah. So 15-year, 10-year interest only. I get the concept of it. I own my properties 100%. So I guess I get the concept of 10-year cash flowing because interest only. You're not really paying the principal down. So in reality, you're assuming that you're gonna raise the rent and maybe lower the expense, maybe property taxes, maybe. So in reality, in right now, you're basically assuming that since you're raising the rent over time, over the 10 years, which more likely than not it would happen, the value is gonna go up. That's the assumption. And then at that point you can exit, or you can refinance again. That's the assumption of that. Since I own my property, for example, right? And I don't know if this is a good strategy or not. It's just me. It's like when I have 2 6-unit and a 5-unit, that since you're saying, we can package just to do a non-recourse loan. What if I'm not attracted to that, right? Like, I get and if I'm missing something, please let me know about my assumption of that.
Yeah.
If I want to pay it off, I just want to put it in a 15-year term, like literally 15-year term, like I want to pay it off 15 years, 15-year note. Is that the first question, is that something that you guys offer? 2, what's the con on that? Because if I'm going to hold anyways, right? Because like if I do a package deal, then that means like I'm pigeonholed to that loan and I can't sell one if I don't like.
That's correct. Yep. That's the negative. So you'd want to make sure you're a longer term holder in order to take advantage of these great, loan terms. The negative would be you can't sign up for a 15-year loan and then try to cross by two properties and then try to sell one off.
Yeah.
That'd be one negative. Yeah.
So the 15-year loan, like I'm talking about 15-year fix and 15-year amortization. Is that something that
Yeah. So, I mean, that's something that on the Fannie Mae side, we can talk about. Honestly, no one that I work with does that because they, at a minimum, listen, I get what you're doing. You have a more conservative approach to pay them down and don't want a balloon balance. But most of my clients,
right,
want max interest only, max proceeds, just so they can juice their cash flows and put that money into somewhere else. And they're confident that they'll see asset appreciation over 15 years, that they're not going to have an issue refining out. I mean, and we run refi tests too, and John can attest. Our underwriting is not 2007 stupid underwriting. It's very we have I think we have $84 billion in our servicing portfolio. We've had like 3 loans go bad in the last 10 years. I mean, it's we're very
So the reason I'm bringing that up is because interest rate is so low. It's crazy low, right?
Right. That's yep.
10 years from now, I mean, who knows what's gonna happen with interest rate, right? Like, and that could drive up the what's gonna be the decision in all this multifamily. That's the only reason why I say that, because really my cash flow is not going to be good, right? Because if I a small a short-term 15-year note and then I'm paying off the principal, but just my mind, if I'm going to hold it anyways, if that's the end goal of it, like I just want to hear everybody's thoughts.
Yeah, I mean, right, because the I hear what you're doing, and paying it off and owning it free and clear would be obviously a zero risk strategy. But a lot of people also would say that you can borrow on a 15-year deal, 30-year amort with interest only at 3%, and have significantly more cash flow on a month-by-month basis, and you can reinvest that money that you're cash flowing into another property or into any other investment that's going to beat whatever rate you're paying on the mortgage. So that's the other side of the coin, is just.
Yeah.
I mean, it all depends on your situation. You know what I mean?
Yeah,
if you have a bunch of cash to invest, it's different, of course. But most of my people not all, but most, are looking to grow and looking to, increase cash flow as much as they can. Some don't do any interest only and just do a 30-year AM, which is fine. And maybe they only borrow, if a $4 million appraisal comes through, they only borrow $2 million. So they borrow half, just a lower leverage deal. That price is sub 3 today, probably in the 2s. And they do it that way. But there's a strategy. Everyone has a different strategy, and we can tailor our products towards that. The lower risk, the lower leverage, the better the rate's going to be. So that's something to keep in mind too.
So let's say, sorry if I'm hugging, if somebody else has a question, just one more thing. Can you still do a supplemental loan? Let's say, or like, I don't know if, I'm not as familiar. Obviously, my biggest deal is 6 unit. But is there, like, can you put like a loan on top of the 15-year, let's say, to just what exactly you say, if I have enough equity and I want to deploy some, investment dollars, then can I tap into that?
Yep.
Can you even do that? I don't even know if you can do like a HELOC on the investment property when it's like that. So I don't know.
Yeah, I mean, that's one of the benefits of Fannie, Freddie, is the ability to come back and recoup equity down the line. So if you do a 15-year deal, they want you to have some term on the first, because they're coterminous if you two have a second mortgage. So as long as there's about 7 years or so left on the first, you can borrow up to the max leverage on the supplemental if you want to. So there's a different whole underwriting process that goes through on a supplemental, but I've done several of them over the years, and a lot of times people are using that money to either buy a new property or to pay off investors at a much cheaper rate than whatever they're paying them on the equity side. So it's a nice added feature, and again, all non-recourse.
Cool. Thank you.
No problem.
For closing costs, about how much are they, like, as a percentage of the loan typically for the small balance loan
The small
program that you
balance
mentioned?
program, so the costs, usually when we sign up an application, we collect $10,000 up front, and that money goes towards ordering all third-party reports, site inspection, insurance review, lender legal, et cetera. So, let's just cut a $1.5 million loan. You have a $10,000, app fee, which the app fee is the same if it's 1 million or 6. And then the origination fee is a 1% origination fee on the smaller deals. So you're looking at, call it on a $1.5 million deal, call it 25 to 30 grand in total costs. So the costs are higher. A lot of banks will just, I don't know, maybe you pay an appraisal and that's really it. I guess the difference is in ours is where we, it's a little more expensive on the front end, but there's long-term value in the non-recourse, and you're holding a lower rate for a longer period of time, and in this environment, a much cheaper interest rate. So I've had several deals this year where bank borrowers, I had to sell them on why it was a good idea to go Fannie or Freddie, and you just run an analysis, accounting for the front end costs. But when you're saving 50 to 75 basis points in rate over 10 years, it's, from a financial perspective, and if you have IO in there too, it's much more attractive to pay the fees up front and to take advantage of Freddie and Fannie's terms.
We had a question, Luke, you might not be able to see on your end, from Adam. How does the supplemental loan work if a $2 million property refinanced with a $1.5 million cash out at the stabilization point has a future NOI that drives a $2.5 million valuation in, say, 5 years? How much can be removed with a supplemental loan? What is the process, costs, and requirements?
Yeah, so supplementals, if you are at max leverage, you can lever back up to 75% of appraised value at that time, and a 1.25 debt service coverage. Those are the constraints. So you have to run the underwriting based on income and expense, and then also take into account whatever your first mortgage P&I is, because you have to blend them together. And then it has to combine to a 75% of value, 1.25 across both the first and the second. And the process is similar to a first mortgage, as far as you have to get an appraisal, third-party costs, and site inspection, insurance review, et cetera.
So in that example, just some quick and dirty math. I just did the math while you're talking. So 75% of that would be 1.875 million. So you subtract out about 25 grand again, and you get, 1.8. So you could pull out, it looks like 300,000 or so in that scenario.
Right.
Supplemental.
Correct. Yep. Sounds about right. Back of the envelope. Yep.
And that's something I think that local banks don't do, from my experience. Maybe differently, but your average, say, 12 unit or 20 unit or 30 unit, whatever it is, your local
in my
bank's not gonna do that.
experience, yeah, and I wasn't around in the heyday investing, like back in before the recession. But most of my investing's been done, at least on the stuff I own on the principal side. Dealing with banks, I haven't had any luck getting them to even reconfigure the loan or whatnot. They're pretty strict on holding to the terms. They have some of them have decent products when it comes to buying a property that needs significant value add, but they're really if it's a larger deal and really qualifies for the non-recourse Fannie Freddie side, you at least got to consider it, because especially today when rates are significantly lower than what banks can offer.
Hey, John or whoever, I recall from a prior life that there was prepayment penalties with a lot of these, the Fannie Dust program, among others. Could you go into that a little bit, if applicable? And then I'm also curious about the low income calculations. If you could tell us a little bit about when you say X% of the local median income, could you define local for us and things like
Sure.
that?
Yeah, so to answer your first question, the affordability question first. So the way the agencies look at it is they define affordability based on simply taking your rent roll and running it through their Excel model to certain levels of AMI. So basically, and this also depends upon where you are at. So Chicago MSA, which includes all the surrounding suburbs, is considered a high cost market. So versus Des Moines, which is considered a standard market. So in Chicago, if you're renters, and I can send around just a breakdown of what the rent levels are for studios to 3 bedrooms to hit the affordability metric. But in Chicago, they consider, they being the Freddie and Fannie, consider affordability to be someone earning 8% of AMI or lower. And then they spit out a rent, and I think for like a 1 bedroom rent, it's anything under $1,200 a month essentially would qualify as a workforce affordable unit in their eyes, and therefore would translate to you better terms, better pricing, more interest only, because it's meeting their goals for the year that are sent out by the FHFA.
Okay.
And I can send around, it's based on county. So if you're in Cook County, it doesn't matter if you're in Northbrook or Cicero. I mean, it's the same, which is kind of interesting. But
yeah,
right. So that's listen, it's not. You could argue all day if that's right or not, but that's how they do it. So yeah, it works out nice. Most deals that are kind of class B, B minus, into the C's all qualify as mission-driven workforce housing. To answer your second question, yes, there is prepayment penalty. So the way these deals work, and standard 10-year deal on the Fannie side, it's packaged into a mortgage-backed security and sold off to the market. We at WD service a loan, so as John will tell you, I'm your first contact for the life of the loan. We service the loan for our clients, but we sell off each individual deal to an investor that on a 10-year deal they're investing at 10 years of cash flow. So
right.
If you want to pay it off in 5 years, there would be a prepay penalty. That's why they offer a very aggressive supplemental program, or there's also assumptions. So let's say you financed a property, 10-year loan, and in year 5 you want to sell and you find a buyer. You can do what's called an assumption plus supplemental. So the new buyer, so long as they're meet all the criteria, could assume your mortgage that you have in place, and then at the same time take out a supplemental loan to bridge the gap, so they don't have to put so much equity in front of the deal. I've done several of those over the years too, and it's worked out, and it's kind of a way to get around it, so you're not handcuffed in the event you had a great offer from a buyer.
Yeah, in a raising rate environment, I would think that that kind of program could be very attractive. I remember back when I was a young man, and they had all kinds of residential loans that were assumable. Boy, they were
right.
Yeah, hot items.
Yeah. So that's a lot of my clients are putting, like I said, 12, 15-year money on it because the rates are great. And in the event they do sell, someone coming in could still take advantage of that great rate for the foreseeable future, and then do a supplemental to bridge the gap. Yep.
Interesting. Thank you.
Yep.
Can you get this small balance loan program with like an LLC with a couple investors, or do you have to kind of just do it yourself?
No. Most of my deals, John's deal was a little bit of a anomaly in that it was just him and his partner. Most of my deals that I do for people, they create a single purpose entity, an LLC that they control. Usually the people there's a controlling interest side. So that's our key principles on the deal. They manage the day-to-day, they put the deal together, et cetera. But a lot of times when they buy a property for $2 million, and let's say they put $1.5 million in debt on it, they raise $500,000 of equity. A lot of times the key principals or controlling members only put in 10%, so sometimes 5%. Others put in more than 50%. It depends, but we do deals all the time where clients do a friends and family raise, equity raise, or country club raise, or
I have a question about that. So if I were to, refinance, a couple of my properties and make it a package theoretically, do you need some kind of like, because I know sometimes it requires some, partner balance sheet, to make sure that, my liquidity is, because if I don't have a partner, right, how does that work?
Yeah, so general rule of thumb is if you're doing, general rule of thumb on non-recourse lending is you want to have a net worth equivalent to the loan amount. So if it's $1 million loan, $1 million net worth, and liquidity of either 10% or 9 months debt service, whichever is lower. So these days it's 9 months debt service. So like on $1 million loan, you're looking at 80-ish, whatever it comes out to, call it 80 to 100 grand total in liquidity. They'd want to see from the key principal. So if it's just you yourself, it'd be your own balance sheet. Or if you have partners, you can put them together, and that would meet the requirement as well. But yeah, they're a little stricter than banks as far as what your balance sheet looks like.
Makes sense.
And Luke, just to kind of chime in, I mean, you're kind of touching on the idea of syndication, right? So a lot of this is kind of like borderline between a JV partnership and syndication, it sounds like, with the people you're working with.
Correct. Yep.
Yeah, and
I have a client that I've done 10 loans with, my team, I should say. I'm on a team of 4. So we've done 10 plus loans with them, over 100 million in financing, and they've never put more than 5% of their own money in any of the deals. And they've been very successful doing it that way. Others put in all of it between the KPs. So it all depends on what your investment criteria and what your strategy is.
What's the down payment that you typically have to do on these loans? On
an acquisition, you can go up to 80% of purchase price as long as it hits a 125 debt service coverage. So that's another difference. I think a lot of banks kind of tap out at 75%. So if you're a max leverage borrower, you can get more money, better cash flow, interest only versus a bank. In the COVID era, they've kind of cut back a little bit on cash out refis. Used to be 80%. Now it's really 75% LTV on a cash out refi. And between 125 and 130 debt cover, depending upon the market. Chicago is 125. Chicago is still considered, a top 10 multi-market by both agencies. So that's great for us.
That's on any loan or just over $1 million? The 20.
The loan, yeah.
The 80% LTV.
That's on the small balance program. So it's really 1 million.
Just want to clarify that because I see something.
Yeah, there are some smaller shops. Yeah, there are some smaller shops that might do smaller than $1 million, but not very many. Yeah.
Gotcha.
Anybody else have any kind of final questions for Luke? He's just provided a ton of value, and I'm sure a lot of us, our heads are exploding right now. I know mine is. A lot of big words.
Listen, I've been doing this for 14 years, but John's deal that he's under contract now, it's Cicero, right, John?
Yeah.
That deal is going to be a great. We don't really have on the small balance side, at least, value add programs or AC rehab programs. They have those on the large balance side on deals that are 6 million and up, but not as much these days in the COVID era. They're kind of cutting back on it. But anyway, that deal that John's taking down now with his bank, he'll implement his plan. He'll reposition it. He'll manage it more efficiently, and then he'll come back to me when it's stabilized now, and then I can take him out of his bank and do exactly the same thing we did on Lombard and Berwyn.
Using Forest Park, John?
Yeah. So exactly. I am using Forest Park National Bank, and this time I think the plan's a little tighter. So on the front end, we're going to use a construction loan. So they're very aware that we're going to cash them out at the end. Hopefully 12 months, but with COVID, it might be 18 months. Who knows? I have 18 out of 22 leases in place. So we'll see how much sweet talking I can do to get people out so I can get new people in. We'll see.
Whoever, John, if you can share some of those statistics about affordable housing, I'm very interested in that.
Yeah, I'm happy to circulate that. I'll show you what the rent levels are for Cook County. And I can do DuPage County too if you want, or whatever county, but it's different by county what the rent levels need to be.
And Luke, you can correct me if I'm wrong, but I think that like the Berwyn deal we did was pretty easy to qualify, right? Like we were
Yeah, that thing qualified all day long at
Yeah.
100% mission driven or affordable housing. Yep.
And we pushed the rents there for people who are listening to, as close to market as I could get them. They were new rehabs. So, I was pushing to get every last dollar out of it.
Right, and it's not an ongoing test. It's just so long as it meets it when we're originating the loan. If you exceed those rents down the line, they're not gonna reprice your loan or anything. It's set.
So, I think a lot of the suburban markets and probably some of the city markets, it's pretty easy to meet that criteria is what I'm getting at. Like you referenced, B-class
if you're not
markets.
Class A with a bunch of amenities and whatnot, yeah. But if it's B minus, into the C's for sure, it's gonna qualify.
Yeah, it seems from what I've learned, and I'm still pretty new at this, it seems like the Fannie Mae program, for many of us, it's the perfect solution when you get a deal that's big enough, and you obviously have to have probably a team going on. It's probably not just one person in most cases, but if you have a couple partners, it's a pretty amazing loan product. You just have to survive the paperwork at the beginning, and then you'll be in love with it afterwards.
Yep.
Anybody have any last questions for Luke? He's and also I think Luke, we didn't really highlight this much, but you also have done some pretty well on some investments, like you mentioned earlier, like in the city as well, right? 3 units and 4 units and stuff.
Yeah, so I have two partners. We put together a company in 2014, 2015, and our first deal was 3234 West Division, which is on the west side of Humboldt Park. It definitely wasn't super scary, but it was kind of scary over there. In an area that we thought had a lot of potential because that park is actually an amazing park.
Yes.
It's got a lot of good things going for it, and things have turned around. Unfortunately, with that recently, I'm not sure how it is over there now. But anyway, yeah. So we bought that 3 flat, and then we also bought a couple of deals kind of on the 606 in 16 and 17. And then we got one in Logan Square, kind of right by Revolution Brewery. That one's right by the train line, the California stop. But anyway, we sold the first 3 we bought. We sold in 18 and 19 at a nice profit. Now one was complete value add, the other was turnkey, and did well on both of those. And we're gonna hold them in Logan probably forever. It's such a good location. I don't want to sell that one. And then we're also doing some of that. My partners had moved to Denver, so we're looking in that market right now a little bit, just to diversify out. And we're still looking at Chicago too, but Denver's got a good demographics going for it and low real estate taxes. So we're kind of playing 2 markets.
Do you do out of state investing, or for the loans? Do you do out of state? Like,
yeah, I'd say most of the deals I do aren't in Illinois. I probably finance 25 to 30 loans a year. I'd say maybe 20% are in Illinois and Indiana and Wisconsin, and the rest we follow our clients across the country. So right now I got deals I'm working on in Indiana, Indianapolis, South Carolina, Florida, and we have a deal in Iowa. So we're
cool.
Are there any markets that are really hot right now, Luke, that you're seeing where you're seeing people you feel like you're getting great values? And I know that's kind of a broad question, but if you're doing these big loans all over the place, you might have kind of a sense of where people are finding the best value.
Sorry, John, my earphones went out there, so I missed that question. What was that?
No worries. I was just going to ask, like, where are you seeing, a lot of these loans happen? Are there any specific markets that are really interesting, where you're seeing people get really good values, where you think, maybe the tailwind is behind them instead of, them fighting uphill against taxes and regulations?
Yeah. There were several markets before COVID that were, on the up. Austin, Texas has always been a big one. Savannah, Georgia, the Carolinas, and several markets in Carolinas were hot. Chattanooga, Tennessee, Des Moines, Iowa. Milwaukee, Minneapolis has been good for a long time, and then certain pockets of Chicago too, where there's some good opportunity. But now it's hard to say, especially with it depends on what sector you're looking at. If you're looking at Class A versus Class B or C, it's just a different ballgame. With all the new construction in Chicago, I think the Class A markets, I'm hearing 3 months concessions on new leases right now. On some of the bigger deals downtown, so that's obviously concerning. But I think the markets that are going to do the best out of this whole pandemic are probably the markets that obviously see significant employment growth and kind of a lower tax basis. So I'm not sure how that means, what that means for Chicago, but some of the a lot of people are thinking the Californias, New Yorks are gonna see some pain here as people try to get more space and move away from the urban core, and they somewhere they can afford if they don't have a job for a while and whatnot. So people are thinking a lot of the states in the Southwest, New Mexico, Arizona, Oklahoma, etc. Texas has always been strong. It's kind of its own animal. Are going to benefit out of this. States that are pro-business and lower tax, which unfortunately is in Illinois, at least right now. Unfortunately.
And Luke, I missed one question from Adam, a follow-up question. If it can be determined from financing volume, are there neighborhoods that stand out as having a lot of deal flow in the moment? I think he's thinking Chicago here. From an underwriting, assessing so many properties, where are you seeing strong values in the greater Chicago area?
Yeah, listen, I haven't done a deal in the Chicago area in a while. I think when's the last time? It might have been your deal, John, that I did. It was the last deal I closed that was Chicago based. I think a lot of people are not bullish on downtown or anything near downtown right now. I think people are kind of actually transitioning to the suburbs a little bit. So well-located suburban locations, anything that has a decent proximity to a metro or, really strong employment drivers and traffic counts, et cetera, is going to be strong. And I think you may see a rebound in the suburbs just because people are moving out. Workforce housing is, in well-located, safe suburban areas. I think there are several pockets you could choose. West suburbs, obviously, and then others too, north, northwest, maybe some places in the south side as well. So
awesome. Well, Luke, we're getting towards the end of our time here. I want to be respectful of your time. Thank you so much for coming on, man. This was amazing. And thank you, everybody, for being here. I think we're going to wrap this up tonight. We will be virtual again next month. So final Tuesday of the month, every month. And thanks again for coming tonight. This was awesome.
Thanks, guys.
Hey, John, why wasn't it next month? Isn't next Tuesday the last day of the month?
Yes. Yeah. So next